Welcome back. And this next video, we're going to talk about an interesting type of transaction, and it's called a repo or a repurchase agreement. Or the other side of this would be a reverse repo. So we're going to talk about repos, reverse repos, repurchase agreements. This is a type of transaction that operations professionals, especially people dealing in government securities, mortgage-backed securities, you're going to see in the ops side. So let's get started. I'll go through my disclaimer here, but I want to just say one other thing here. And again, if you really want to know the details on this, the accounting side, you really need to get something like the book after the trade is made. I actually took almost word for word everything on the slides I'm going to show here from Investopedia. So if you really, Investopedia, as I say, is a great source, and you'll find all the same information there. So repurchase agreements. So what is a repurchase agreement? A repurchase agreement, or a repo, is a form of short-term borrowing for dealers in government securities. So this is for the government securities here. We're talking about treasury bills, bonds, notes. We're talking about U.S. treasuries, and we're talking about mortgage-backed securities, Fannie Mae's, Freddie Mac's. I saw a lot of these actually in the mortgage areas. This is fairly popular. Okay, so in the case for repo, a dealer sells government securities to investors, usually on an overnight basis, and buys them back the following day at a slightly higher price. The smaller difference in the higher price covers the overnight interest that would be due in this transaction. Now, why does he do this? You've got a dealer who has a lot of assets. He's got securities, or she has securities, firm has securities, and they're just sitting there as collateral. And the dealer might need cash overnight to fund other transactions, to fund the settlement of some other deal. So the dealer might need money just for 24 hours. They might need money just overnight, right? They might be doing some foreign transaction and they need cash, but they only need the cash for 24 hours, or just overnight, or over a weekend, or over a holiday weekend. This would be very common. We have like a 3-day holiday, like a 4th of July or Independence Day weekend or Memorial Day weekend, or where there's an extended weekend holiday where they need cash. So the dealer needs cash. So the dealer uses collateral that they own, and it has to be securities that they own free and clear. It can't be securities that they have got margin claims against or some other segregation issue with. All right. So where the dealer needs to borrow money overnight, instead of going out and borrowing the money, what they effectively do is they do a repurchase agreement where they agree to sell you the security and then buy it back at a slightly higher price. And that delta between the price that they sell to you for and the price they agree to buy it back at, that's the overnight interest. Repos are typically used to raise very short-term capital, meaning capital for 24 hours or over a long weekend. Just very, very smart. And they are a common tool of centralized banks, bank open market operations. For the party selling the security and agreeing to repurchase in the future, it's a repo. But for the party on the other end of the transaction, buying the security and agreeing to resell it in the future, is called a reverse repo. So let me step you through this. And I'm going to give you an example. And this is a case where visuals hopefully will help make this clear. Here's the example. You've got a dealer. Now the dealer right? Remember we talked about dealers. Dealers take positions, settle them against the street, and actually own the assets. So the dealer needs cash overnight or over a long weekend or for a couple of days. Usually it's going to be overnight. The dealer needs money tonight. That's what it boils down to. The dealer needs money tonight. So the dealer has government securities that are available. They're free and clear, right? And what I mean here is the dealer actually owns these securities. The dealer doesn't have these. There's no claim against these. There's no, he hasn't, it's not part of another transaction where he's selling the securities. He doesn't have any margin against it. They aren't, these are securities that are clear for the dealer to sell. So the dealer needs money and the dealer has collateral. So the dealer says, I'm going to sell these securities. So the dealer agrees to sell the securities overnight to an investor, usually overnight, could be for a couple of days, and agrees to buy it back at a slightly higher price, right? Now, that slightly higher price is where the investor makes their profit, right? And that slightly higher price is determined by figuring out what's the overnight interest on, let's say this is $100,000 in mortgage-backed securities or federal securities, treasury securities. Whatever the overnight interest on $100,000 would be, that would be how much more the investor would sell it back for. So the dealer and the investor have a contract, a repo contract, where the dealer's agreeing to sell it, and he's going to, and the investor's agreeing to sell it back to them, and the dealer's going to repurchase it at a price slightly higher in order to pay the overnight interest, right? So that increase that he's going to agree to buy it back at, that's the interest. That's how the investor, on the investor side of the transaction, is going to make money on this transaction. So that's the repo contract, right? Now remember, these are not transactions. These aren't going to be repos like this. Aren't going to be, you're not seeing these when you go up on the board for the, you see transactions from the New York Stock Exchange or NASDAQ. These transactions are done outside of that, right? So for the party on the other end of the transaction, like I said, the investor, he's the reverse repo, and the dealer side actually selling to get to borrow the money. That's the repo side. So let's look at how this looks. The dealer's doing a repo. The dealer has the asset. The investor has the cash. They agree to the transaction. So what do they do on day one here? The T, trade date, right? The asset, the securities, the government securities, move to the investor. The investor buys them for cash. Okay, now the investor is holding that collateral. So that's how he's securing. He knows he's not going to lose money because he now has the collateral. The dealer now has the cash. So overnight, the dealer's firm can do whatever he needs to do with that cash. Maybe it's another transaction it's used in, it's used somewhere. Okay, so now it's the next day. Now we go the next day. So what happens the next day? The next day, the investor sells the security back to the dealer at a slightly higher price. And so where we end this process is, we started the process with the dealer owning the security and the investor having cash. Then the investor sold cash to the dealer sold the investor the security to hold his collateral. And the next day he sold it back. So we end up back, in the end, the investor has the cash and the dealer is back to holding his security, which he can then use for other transactions. That, in a nutshell, is what a repo is. I hope that's clear. Again, this is something you're going to see if you're an ops person dealing in the government's markets or the mortgage backed, like Freddie Mae's and Fannie Mae's and Ginnie Mae's. You know, you're going to see these, or you're working with U.S. Treasuries. If you have any questions, please contact me at the address listed below. Thanks and have a nice day.